Crowdfunding tips for self-directed IRA investors. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. In today's video, if you're looking to use your IRA to invest in crowdfunding type investments, i.e. private placements, investment into private businesses, fractional real estate, this is the place you need to be. This video will tell you pretty much everything you're going to want to know to keep your investment safe. So what's a crowdfunding investment? As I mentioned, it's basically pooling money from various investors to get access to certain private placement investments into private businesses, real estate deals, hedge funds, different types of investments where a number of investors come together and pool resources to make the investment. So here are the most important items you're going to need to remember if you're using a self-directed IRA to do some crowdfunding. One, you're going to have to be an accredited investor. Now there is a Reg CF that allows a investment firm, a promoter to raise up to $5 million without going after accredited investors. The problem is most crowdfunding opportunities tend to raise more than $5 million. So that means they're going to need to register with the SEC. Now, in order to limit their responsibilities, because there are very, very in-depth reporting requirements to register an investment with the SEC, time and cost, there are Reg A's and Reg D's. And those are two ways that you can satisfy the SEC rules and have some disclosure and some paperwork to the SEC, but a much, much, much lower threshold. And that's why the private placement crowdfunding investments tend to file in Reg A's and Reg D's. Again, I'm not gonna go through all the details in Reg A's and Reg D's, but bottom line is it allows them to raise more than 5 mil, but generally most of those investors need to be accredited investors. An accredited investor is someone who makes more than 300K, married, filed jointly, or $1 million of net worth excluding primary residence. So as long as you have that money personally, your IRA or retirement account will comply and be deemed an accredited investor. So that's number one. You're gonna need to generally be accredited unless the investment's part of a crowd CF and is raising less than 5 million, or just like a friends and family thing where just a couple folks are getting together to make an investment, not being publicized or advertised, just kind of getting together and doing it. Second thing to remember is due diligence. I mean, these are generally riskier investments than buying Tesla or Apple stock. Yes, there is some minor SEC regulation, but that's why you have to be accredited, is because there is a greater risk of loss than just buying fixed income bonds or publicly traded securities, which have a far greater reporting requirement, i.e. quarterly reports, annual reports, things like that. Okay. Next thing you got to worry about is good old UBIT, unrelated business income tax. If you've watched a lot of these videos, my videos on this channel, you've heard that ugly 4-letter word. You've heard me mention it repeatedly, UBIT, whether I call it UBTI or UBIT. Basically, it's an ugly 37% tax imposed on income of over $14,500 from either a charity or a tax-exempt IRA or 401k. It does three things. Invest in an active trader business through a pass-through entity like an LLC, and that's what a private placement is generally. Invest in real estate with leverage. There is an exception that could be used for 401ks under 514c9. It does not apply to IRAs. Or thirdly, if there's an investment into, let's say, an airplane type leasing facility that has leverage, okay, or you're using margin to buy stock. So the big one to worry about for crowdfunding, private placements, is investing in an active trader business through a pass-through entity. So what you need to consider is if you're investing in a crowdfunding opportunity, if the underlying business is a corporation, a C Corp, you're good to go. There's not going to be UBIT. That is why when you buy mutual funds, ETFs, or Tesla, Apple stock, you don't have to worry about UBIT. Why? Because it's 99% of all publicly traded companies are corporations, and it blocks the application of the UBIT. But if the crowdfunding platform is a pass-through entity like a limited liability company, a partnership, there's more than $1,000 in net income allocated to the IRA, the UBIT tax can kick in. It can go as high as 37%. of around 15K in income. So it's something to consider. One way to block it is set up what's called a domestic C Corp blocker, which our highly trained IRA Financial team can assist you with, where we set up a C Corp blocker. The IRA invests in the C Corp. C Corp does the crowdfunding deal, and you can reduce the 37% UBIT tax to 21%. Hard to eliminate it, but I can at least reduce it down to 21, which kind of mirrors long-term capital gains for some investors. Not the end of the world. So if you're looking to do crowdfunding with your IRA, obviously a quick recap, you gotta be an accredited investor. Please do your diligence, research who's promoting this thing, read the documents, and thirdly, consider UBIT. UBIT could tear up a deal, make it very tax inefficient. So another good reason, yeah, you wanna work with IRA Financial, who's been doing this 13 years, over 25,000 clients. Like, we know this stuff. And if the deal, we'll help you navigate these rules, because if the deal just becomes too messy with UBIT, like, we'll tell you, do it in personal funds. It's not a good IRA type deal. We'll help you navigate these rules. Yes, you're in charge. It's a self-directed deal. You make the investments. We do not make investment decisions for you, but we can help you navigate these rules and help you become the most tax efficient self-directed investor you can be. That's what I do for you. So thanks for watching. Appreciate you guys spending some time with me, and definitely stay on the channel. There's amazing videos here, and I hope to see everyone again on my next video. Thanks.